This segment sponsored by Foster Financial. Welcome to Wealth Wednesday, giving you a weekly dose of financial insight with Caleb Doan, the Vice President of Foster Financial. Hi, Caleb.
Hi.
Welcome back.
Thanks very much.
Yes. Okay, so of course we always cover things that are happening. And right now the U.S. is going through a bit of a credit crisis. And they went from 3 A's, they lost an A. Break it all down for us, please.
Yeah. So we've gotten a couple questions on this, so I figured it would be helpful to just kind of bring it up on here. Essentially, last week, one of the big sort of crediting agencies named Fitch Ratings, they downgraded the United States' credit quality, essentially, from a AAA, which was the highest that you could possibly be, one notch down to a AA plus is what it is. And so it's a relatively, modest deduction, I guess you could say, but it still does kind of signal a bit of a change in kind of American politics over the past maybe 10 or 15 years. And so I figured it'd be helpful to chat a little bit about today.
Yes, absolutely. Because you would think, I know that in the news discussing our debt ceiling and our increased debt and all of those issues, what is the impact? And I think a lot of people didn't realize that the U.S. is actually rated just like we are as individuals.
Right.
Okay, and so tell me, what caused this change?
Yeah, so there were a kind of host of factors. I'd say probably the two biggest ones are, back towards the beginning of the summer was that whole debt ceiling issue that you brought up. And this has happened over the past, couple times that we've gone to raise the debt ceiling, is that it's gone down to the wire on when we could actually raise it. And so it just kind of brings up these concerns about, hey, if we were to hit the debt ceiling at some point and we didn't raise it, would the government actually default on some of these debts?
Right.
And that's really what that credit quality rating is rating right there, is the U.S.'s ability to make good on all of its debts. And so one of the implications there is the debt that the U.S. has is mostly in treasuries. And so people can go in and buy these treasuries, and if you buy a treasury bond, the government is essentially indebted to you. They need to pay you interest on that. And so one of the potential implications is that if the government's credit quality is going down slightly, then the market might require a slightly higher interest rate from the government, which is really exactly what would happen with us too.
Right.
It's like if you're young and buying your first house, maybe your credit score is a 600 or something like that, and you might have to pay a 5% interest rate on your mortgage. By the time you go buy your second house, maybe you have a higher credit score, and the bank gives you a slightly lower rate. And so it's just that potentially in reverse with the government when you get downgraded.
Yes, and it kind of impacts the world's view of the United States. And I know that the Treasury Secretary was not happy with this rating, and because it really did imply that the U.S. just mismanages their funds and they possibly will not be able to pay it back. And I was reading that they predict that later this year we will hit a recession. That was part of it.
Yeah, there's sort of a mixed bag of, different banks and stuff thinking whether we will hit a recession or whether we won't. There's a lot of banks that are sort of drawing that back a little bit, but Fitch Ratings specifically still expects that we would hit a recession. So it's something to keep in mind. And, it just goes to show, and I don't think anybody will be hearing this for the first time, but of course the government is still subject to potential mismanagement and stuff like that. So when you see it go down to the wire before they're able to raise the debt ceiling, it kind of calls into question, hey, if the U.S.'s ability to pay its debts are reliant on these policymakers, how much faith and trust can we put in these people? And so it's just something to kind of consider. And I think it's something we've talked about over the past couple weeks, is just right now could be a really good time for people to take a look at their investment portfolio and kind of reassess how much risk they're taking on, because the calculation has changed a little bit over the past couple months.
Yes, and so we talked about the impact that this has on the United States and their finances. How does it impact us and investors?
Yeah, good question. I think if interest rates are sort of going up a little bit, the main change is, over the past 10 years, that wasn't a thing. Interest rates were really, really low. And so with interest rates going up and, with yields potentially going up a little bit too, with maybe a downgrading of treasuries, it's possible people can hold more conservative assets and still get a pretty decent yield on it.
Okay.
And so I think if people are out there and they felt like they were on a roller coaster over the past couple of years with their finances, it could be a good time to take a look, and especially with those people who are just taking consistent withdrawals from their IRA. A lot of times we like to figure out the exact amount that somebody can withdraw sustainably from their IRA. And if somebody's taking low withdrawals, they might be able to be invested pretty conservatively and still have a sustainable, nest egg for retirement.
Just got to keep watching and keep looking and keep providing that information. So thank you so much, Caleb.
Yeah, you bet.
We appreciate it. And Foster Financial can help you break down current events and provide holistic financial planning. Give them a call today. We'll have their number listed below, and we'll be right back. This segment sponsored by Foster Financial.